congratulations on earnings and on another
Thank you
great
very
quarter.
much.
And on quintupling asset size since 2020. Can we expect more? Is there a sweet spot, or will there be more assets under management by the time we speak to you again next quarter?
Well, there'll be more assets under management, I hope and expect, by the time we speak again, and I do look forward to that. Look, I look at assets under management as really an output or result, not an input. At our firm, we don't aspire to manage more AUM, but we appreciate the opportunity to manage more AUM by delivering great results. To us, we always get back to is, let's come up with opportunities where there's mismatches between supply and demand and capital, where we can deliver, in particular, our DNA, more principal protected, downside protected, income-oriented strategies, and deliver outstanding results.
Yeah.
Assets will follow that.
All about getting the return to LPs and so on.
Absolutely.
At the same time, you have made a lot of acquisitions to that end, of course. Should we expect more acquisitions, and what should we expect organic growth-wise?
So most of our growth has been organic. It is true that we've made a number of very important acquisitions. The data center business, really important for us. The alternative credit business, certainly going back a couple of years. Our real estate business are incredibly, they're great franchises, and they're great parts of an integrated Blue Owl. We'll continue to evaluate always organic, inorganic opportunities, but I will say we have all the pieces that we need for the chessboard, and we actually have our investor day tomorrow, and we're going to be really laying out where we how that chessboard comes together and how we're going to play it in the years ahead.
You've crossed $100 billion in assets under management just in terms of private credit, and I'm wondering, at this point, and we've asked you this question before, but now, what innings are we in?
We're in the middle innings. It's certainly not the earliest innings. I remember those days well, when it was a novel idea. It's not novel, but it's still, here's the bottom line, it works. Look at 2024. We had a very, very active origination year, and that was in the face of a very tepid M&A market and a very wide open liquid syndicated market. So even in a market that you would consider kind of least hospitable, if you will, to private credit, what we've demonstrated is it works. It works for the user of the capital. It works for the investor. So I expect we will continue to gain market share, and we'll continue to hold on to the clients, the users of capital that we have gained the trust of. So I think we're in the mid-innings. It is clearly a time where scale matters. Look, we have a huge team of people working on underwriting. We have a huge knowledge base that we work with to make these decisions. We've looked at 10,000 loans. So I think we're well past the time where it makes any sense for there to be new entrants. We are at the stage where there's a bit more about the big getting bigger and how do you continue to deliver those solutions.
We are seeing dispersion in credit quality metrics, perhaps, not defaults, they're not exploding, let's say, but we are seeing dispersion. So how are you dealing with that? And in terms of valuations, how are you looking at what you have on the books already?
It's a wonderful question, because where we started this firm and where we start every day in credit, it's all about credit. I mean, really tautological, but it actually wasn't the case 10 years ago when we really started this wave forward of being a lender of first choice for the best credits. So we, though, at Blue Owl have always focused on the larger companies with the largest sponsors in the stable industries, and that has allowed us to originate over $100 billion in loans and have a running realized loss rate of 11 basis points. So it is all about credit, and Blue Owl's particular place in the land of private credit, which can be a wide definition, is very much in the sort of grade A, the best, the most stable, the most predictable, because again, our job for our investors is to provide that core holding that's going to work through a wide range of outcomes.
How does that valuation process work, though? Are you getting enough information from quarterly disclosures?
Oh, sure. We're in constant contact with our portfolio companies. We get lots of information. And then, to be very specific for us, we have an outside firm provide our valuations. So we actually just want to provide all the data we have, get the best information, and present the facts.
I want to ask you about Apollo's platform that it has been reported upon it's going to start, so basically a marketplace for private credit. And Matt Levine was writing about this recently about, when is private credit anymore? Well, if there's a marketplace, is it even private credit? Comment a little bit on whether that's something that you would like to do.
So it's not something that we aspire to do. Our version of private credit is indeed private. We see the advantages of private credit. We talk about the 3 Ps, predictability, privacy, and partnership. And our value proposition that we get paid for is that we're going to be a long-term partner to the people that use our capital, a reliable partner, someone that they can talk to and work with. And that's what we get paid for. The premium, the much tighter loan documents, lower loan to values. So to me, it's endemic to the value proposition. We don't have an aspiration to turn a private market into a public market that already exists. That said, I have great admiration for Apollo, and if this creates more access points for more people to participate in private credit, I always welcome innovation. But our view is we are about being a long-term capital partner. When you borrow from us, we are your partner to the end.
People are fretting a little bit about AI valuations, about capex spending, about what DeepSeek means for the world, and so on. And I'm curious because you do have a lot of skin in the game here. You're partnering with Oracle, you have Databricks, you're giving them some financing, and I'm sure tons of other companies. Are you awake for a few minutes longer at night than you used to be?
So the DeepSeek, or this sort of rapidly evolving landscape, I think is exactly why we at Blue Owl have approached this market the way we have. I don't have the expertise or the knowledge to know on the cutting edge who's going to win or lose. And maybe there are some people that do. But that's a very different kind of risk-return question. Returning to Blue Owl's core, we are about delivering winning solutions through thick and thin, durable, downside-protected solutions. So we provide the core data centers. And that hasn't changed. Now, DeepSeek may lead to somewhat less computing power to train a model, but Jevons paradox may lead to quicker adoption, broader adoption. So on the margin, we're not sure what that yet means, but here's what I know. I know that the people we do business with, look, we have the leading data center development business around. Now, IPI has been at this for almost a decade, long before this was a twinkle in most people's eyes. And so we have the relationships. We've built 85 data centers. And here's what I do know. I know that, and just it's been reconfirmed, right? The Microsofts of the world spending $80 billion. The
forecasting
Facebook,
a spend.
65.
But for example, if they see that data centers are plateauing and that suddenly there isn't as much demand, well, they don't have to spend all of that, right?
They don't have to. They won't be plateauing. But it's worth taking a step back on this, again, without trying to debate the technical elements of DeepSeek. Of all the expected data centers, the trillions before any of this conversation started, 75% of that capital was already expected to be spent on inference and cloud computing. So what we're really talking about is the modulation of 25%. And that modulation, is it wider adoption makes it greater, or is it DeepSeek intensity makes it lesser? But that's what we're modulating. The reason we love our strategies, and I think it works for investors, is we develop a special purpose result for an investment grade, near sovereign quality credits, and they lease them from us. So it's really about their decisions in this AI race. And what I would say is this: DeepSeek probably reinforces this notion. 10 years from now, AI will be a much, much more powerful infused tool in the economy. That takes the infrastructure. Blue Owl is going to finance that infrastructure.
Very last and final question, one word. With all of your experience in sports, who's winning the Super Bowl?
I'm deeply biased.
Sorry.
I want the Commanders to win, but they're not in it. So I'm going to go ahead and say I wish for a great game.
Oh, what a politician's answer.